and former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. And I began trading futures, forex, and stocks for about 10 years ago. In fact, primarily stocks when I first started trading the markets. And I have a background in the optimization of software systems. That's what I did my graduate school work in. And back in those days, I did mathematical modeling of underwater decompression schedules. And when I developed an interest in the financial markets, I look at each financial market as a closed system that can be described by a mathematical model consisting of a series of independent variables. You place those into a multivariable equation and you optimize them. And you come up with a system that can very accurately predict the future movement of price on any financial instrument. And that's how right line trading was born. Now, I think probably everybody here this evening knows that there's a major problem with current technical analysis. And it's obvious because 95% of all day traders or swing traders wind up going bankrupt. Now, that failure rate would be unacceptable in any other field of endeavor. We wouldn't tolerate an architect who put up buildings in which 95% of them collapsed, or you wouldn't go near a hospital if 95% of all patients who were treated died. What happens is that even if at first, some scientific field of endeavor has a high failure rate, other scientists go to work. They do very critical scientific analysis, and they are able to tease out which components of the plan are failing and which work. And so there's an evolutionary process that takes place as each of the variables that are ineffective are eliminated, and the effective variables are left in, and additional effective variables are added. But for some reason, this does not take place with day and swing trading, and the failure rate, or the number of traders who fail, has not improved over the past 15 years. And one of the problems is that each generation of day trader fails to learn from the previous generation. If you look at basic technical analysis, we've added some elegant studies, and one of those is market profile, which I'm going to be talking about, and then the volume ladder. But the core process by which we day trade and swing trade has not really changed significantly. We continue to embody a lot of indicators that don't work. And if you do a Nexus-Lexus search, which allows you to look at the world literature in any single language, you'll find that there's almost no critical studies, no real scientific analysis of day trading to find out which components that we use work and which components that we use don't work. And obviously that's a big problem. And I'll just give you a quick example. Now we're going to look at stocks real carefully, but I want you to just, the oscillator is included in many sophisticated trading packages and software analysis looking to trade stocks that use Renko bars. And the problem is that if you look at the formula for an oscillator, it requires 4 components: the high, the low, the open, and the close of every formation. So that as the low of a move approaches the close, and the high of a move approaches the close, the oscillator continues to trace in the appropriate direction. The problem is this. Now, this is the Russell. It doesn't make any difference whether this is stocks or futures. You can see that the Russell has a high, a low, and an open and a close. And as the low of the move approaches the close, the percent K line is going to fall. When the high of the move approaches the close, you're going to see this move up. So this is an accurate percent K line. Now, if you look at Renko bars, there's only two of those parameters. There's the open and the close. There's no high-low. So this percent K line is totally inaccurate. Now, the problem with using indicators like this, and there are lots of them that everybody uses, is that they don't improve the precision of your trading. They degrade it. And they keep you out of winners, and they walk you into losers. Now, the other problem with an oscillator is that there's two groups of traders, and they each trade it totally in an opposite manner. One group of traders believes when the market's overbought, the bulls are in control. And what they can do is they continue to buy each upside pivot as it's broken. The other group fades the market. When price makes a higher high and the oscillator makes a lower high, they look to take a counter trend trade. And we all know how oftentimes divergence fails. MACD divergence, oscillator divergence, they're very risky propositions when you counter trend trade. You can see all the traders in this move up, in these red candles, trying to counter trend trade and fade the market, and they all get run over. And I'm going to show you why. Now, the other, what I consider to be one of the most costly analysis ever created is Fibonacci. Now, if you know anything about the background of Fibonacci, he's an 18th century mathematician, and he created actually a really elegant thing called Fibonacci transformations, and from those transformations we get Fibonacci numbers, and Fibonacci numbers do have relevance in nature. They describe the number of edges on a snowflake. They also describe the number of ridges on a pine cone. So there is direct applicability to natural systems. But he created these transformations 150 years before the advent of the financial markets. And then somebody got the bright idea to take his numbers, create Fibonacci extensions and Fibonacci retracements, and decided that price on any given financial instrument will respect the support and resistance levels provided by Fibonacci based on the prior swing high or swing low. And what we did was 2 years of market replay data, looking at the ability of Fibonacci support to launch a trade off to the upside, or Fibonacci resistance, take a trade to the downside, and it has exceedingly low predictive value. So low that, again, if you are worried about trading up into resistance, it's going to keep you out of a winner. And if you try to trade off a support, it's going to walk you into a loser. I have never seen a Fibonacci trader make money, although there's a ton of people out there willing to sell it to you. I'm telling you, it doesn't work, or we would incorporate it in our trading system. I have nothing personal. I hold no personal grudge against Mr. Fibonacci. It just doesn't work. And if it did, let me tell you, 95% of day traders and swing traders would not lose money. So ultimately, here's really the bottom line. The predictive value of any indicator that only uses the data from your trading chart is unbelievably poor. You can't look out into the future. You can see where price has been but you have no ability to determine where price is going if the analysis is based on price from your trading chart. So all of those indicators, if they, like the oscillator, like MACD, there's a whole host of others, Williams K, which are all just variations of the oscillator, are not going to help you get into a winning trade. All they look at is information from your trading chart, and your trading chart is not going to tell you where price is going to move out into the future. So I just want to give you a little bit of a sense of trading methodology, and then we're going to get really into the specifics of trading the stock market and doing it profitably. You can trade with a lot of sensitivity, or you can trade with a lot of specificity. And if you don't know what that means, it's really a problem, because you need to know. If you trade with a lot of sensitivity, you're looking to get into every true positive trade. A true positive is every winner. So your goal in day trading is to get into every single winning trade that you can see. Now, if you take that approach, you're going to pull in a lot of false positives, and those are trades that stop you out. If your goal is to trade with a lot of specificity, that means you're looking for the true negatives. And what the true negatives are losers. Then I actually believe half the battle is won if you understand that your goal is not to catch every winner. Your goal is to avoid every loser. Now, if you have that mindset and trade with an incredible amount of discipline and patience in looking to avoid every potential loser, the amount of trades you take in the course of a week is going to drop markedly, and the number of losers you take is going to drop markedly if your trading methodology is sound. You're not going to take risk. Excuse me. And the biggest problem is concern by traders of missing a big move. And you can't worry about that if the trade doesn't align with your trading rules, you know, your golden rules. Then if the trade goes by you, let it go. Never worry about a missed winner, because you're looking to sidestep all the losers. Now, the other parameter that's extremely important is prevalence. And the prevalence of a winning trade occurs when the market is trending. Now, it may seem really obvious when a market is trending, excuse me, I'm just a little bit hoarse, versus whether a market is in chop. But I'm going to show you it is not as clear-cut as you may think it is. And this is another factor that leads to a lot of traders losing their bank account. They can't see clearly when there's a trend versus when the market is in chop. Now, here are the independent variables that we've created after doing years of analysis. We look at the multi-time frame analysis of trend. Now, forget the correlative markets. For stocks, it's a different metric, and I'm going to show it to you. We look at the multi-time frame analysis of order flow. Order flow is a indicator you can never trade against. If you do, the likelihood of a stop out is incredibly high. You have to look at the multi-time frame analysis of momentum and respect a sophisticated volume analysis as embodied in market profile. If you trade an oscillator or a MACD or Fibonacci or Elliott wave, they're just going to confound your trading, because these indicators are driven by this analysis. So you got to eliminate dependent variables and only let independent variables drive your trading, because these are what are responsible for for the future movement of price on your chart. Now let's take a look at two of them. One is the multi-time frame assessment of momentum, and the other is the multi-time frame assessment of order flow. And they're both extremely powerful, and they help define your trend. Now the first line is momentum, and the second line is order flow. Now it doesn't look at any price on your trading chart. It doesn't look at price movement on your trading chart. It looks at the two higher time frames. So let's say that you're trading a 3-minute chart. It's going to take all of its analysis from the 9-minute and the 27-minute. If you're trading, say, an 8 range, it's going to look at the two higher fib numbers, a 13 and a 21. So it's always going to be looking at the two higher time frames, and that's going to drive price in its direction. Now, order flow looks at whether or not there's an overabundance of buyers or sellers on your trading dome. It looks at market depth and determines how many orders are sitting on the bid and how many orders are sitting on the ask. That's extremely important. Now there are some fake trades that institutional traders will put on and then remove them. But in general, this looks not at the raw data, but it puts each candle, the close of each candle creates an order flow number or a delta. That delta is put into a 15-period slow moving average to give you the order flow direction. When this line is red, it tells you that there's an overabundance of sellers on your two higher time frames. When line number 1 is red, it tells you that momentum is aligned to the downside on your two higher time frames. When it's orange, it's only your longest term time frame. When it's aligned, when it's green, there's an overabundance of buyers on your two higher time frames. When it's blue, only the longest term time frame has an overabundance of buyers. Now we're only going to buy or sell the market when these lines are red. We want there to be a total alignment of these two variables in the appropriate direction on our two higher time frames. And when it does, it's going to drive price. And here's an example. Well, this is real price action taken off of a stock. The reason I didn't want to put the ticker up is the ticker's unimportant. I didn't want to put the time frame up because the time frame's unimportant. What's important to see here is that line number 1. Now we did an analysis of MACD momentum, oscillator momentum, and modified Heikin-Ashi momentum. And modified Heikin-Ashi momentum gives you the most precise, gives you the most precise trading entries based on its momentum analysis. So when more order flow and momentum are both green, the only direction you want to trade is long. Now, if you try to counter trend trade this, the likelihood of getting stopped out is extraordinarily high. Now, all these traders, when these counter trend candles, what they're doing is they're trading oscillator divergence, MACD divergence, Fibonacci analysis, Elliott wave, all the things that create a mess for you. And these are the kind of things you want to avoid. You can only trade in this direction. Now remember, this is not giving you an entry. It's only giving you a directional bias. Same thing here. Order flow and momentum are aligned, which is extremely important. I'm going to show you what happens when they don't align. They're not looking at price on your trading chart. So price on your trading chart is rising because this analysis is green from the two higher time frames. They're not green because price is rising. That's what happens on most trading charts. The oscillator goes up because price rises. The MACD crosses to the upside because price rises. price is rising here because these two lines are green. Now, if you try to counter trend trade, and a lot of traders are in this move up, all these orange candles are counter trend traders. They're all getting stopped out. You don't want to be caught in the counter trend direction when multi-time frame momentum and multi-time frame order flow are aligned to the upside. That's how you break out of the market and dump yourself into that 95% loser group. Now, you can take a counter trend trade when they both go red, but any counter trend trade is much more difficult than a trend trade. At Right Line, we really try to stick with the trend trades, but you can counter trend trade as long as order flow and momentum have turned. Now, I wanted to show on this market what happens when order flow and momentum don't align. Now, what happens when these two, remember, momentum is a force that brings pressure to bear on your financial instrument to move in a specific direction. Momentum is telling the market to move short. Order flow is telling it to move long. When these two don't align, price goes into chop. And you cannot trade. When they align, that's when you're going to get your great move to the downside. Again, not trying to counter trend trade against the direction of these two indicators. Same thing here. No alignment here of order flow and momentum. And price is right underneath resistance, and it's just chopping. Finally, when they align, price breaks, comes back to support, and up it goes. Now, here's our multi-time frame analysis. This is COH is Coach. Now, when you get a multi-time frame, this pink tells you that this stock on its two higher time frames is aligned to the downside. And how is it aligned to the downside? The 50-period moving average is red and heading down. The 15-period moving average is red and heading down. The 15 has crossed the 50 to the downside, and price is below the 15 and the 50. So support is broken. Now, this is a 5 range. It's doing its analysis on the 8 range and the 13 range. It's not looking at price on the trading chart. So when your two higher time frames have broken support, and the 15 and 50 are red, and the 15's crossed the 50, and price is below both and heading down, price on your trading chart is going to fall. The only direction you can trade is short. The pink background is not caused by the fall in price. The pink background creates the fall in price. And again, you can see all the counter trend traders trying to trade against the multi-time frame direction of price. Same thing. This is a 14-point move up and an 11-point move up. And you know what? The size of this move is unimportant. What's important is for you to notice that when you get a multi-time frame alignment of trend to the upside, you can only go long. You can't try to counter trend this. And what happens when there's no multi-time frame alignment and trend is a choppy market. Remember, I had told you that the prevalence of a winning trade occurs most commonly when there's a trend. And now you're beginning to see, I hope, and I'm sure you are, that what you need is that you need a multi-time frame alignment of trend. Trend on your trading chart tells you nothing. What gives you all the information you need to predict how price is going to move out into the future is the direction of price on your two higher time frames. Now, you can do all this analysis by using a triple screen. and trade every single stock with 3 different time periods, but it's very cumbersome and very difficult. These indicators do the analysis for you. Now, this is an indicator that we have created that you will not find on any other platform, and it's called our cash metrics line. We just perfected it, and it took us months of analysis. I'm going to show you how it works, and it's going to help you trade really incredibly well. It's incredibly powerful. Now, I just want to, these lines are a little shaky. This is a chart of Apple. It's an 8 range. Now, the bottom 2 lines are order flow and momentum, just like we discussed on these last slides. The first 2 lines are our cash metrics. And I'm going to show you what those are in a second. Now, this is a consolidation entry. You're in 1 tick below the close of the candle, and maximum excursion on the trade is 44 cents. You risk 10 cents to make 44 cents on this trade. The risk to reward is just incredibly good. I can't pronounce it, but it's awesome. If you can make you could make 4.4 cents on every cent you risk. Now, I'm going to go in a little bit of what the cash metrics are. There are 21 indices that have been broken up into 4 groups. There's a Dow group, there's a NASDAQ group, there's an S&P 500 group, and there's a Russell 2000 index group. Now, I'm going to show you just a few of the indices that we track in these lines. We track the ratio of up-down volume, the ratio of the advanced decline line, the ratio of stocks on the uptick versus stocks on the downtick, and then we break that up further into the advanced decline line on specific major ETFs, and the ratio of uptick, downtick, stocks upticking and downticking on specific ETFs. And we have additional baskets, but these are the only 5 that I really want to get into, because it's taken us a long time to create all of these signals. Now, these are the lines right here. Now, when you get a green signal, you know right off the bat that a whole bunch of things are happening. Number 1, you have more stocks upticking than downticking, and Facebook goes into the NASDAQ basket. So that's simply where you triage it when you build your chart. So on the NASDAQ, you have more stocks on the uptick than the downtick. You have more stocks with up volume than down volume. You also have more stocks advancing than declining. You also have specific ETFs, and we had to do a lot of work on those that contain Facebook. They are moving up, looking at those same metrics. Advanced declining, volume up, volume down, uptick, downtick. When both these lines are green, the bottom line's a little slower, the upper line's faster. The likelihood of getting a winning trade off of a software-generated signal is exceedingly high. This is a strategy entry, and you're going to see that it's going to give you an entry on our trade scanner. You're going to make 40 cents on this trade and risk 10 cents. And here's another example. This is coming right off support of the value area high. I haven't really talked about it yet. This is Perrigo, generic pharmaceutical company. And a lot of people think you can't make really good money off of stocks that are not, high beta stocks like Facebook and Google, Netflix, but you can make great money off of these moves. The problem with stocks like this is you can't sit and watch them all day. But our trade analyzer, trade scanner, is going to give you the ability to watch 100 stocks or 200. That's a C candle entry. It's going to signal you when both cash metric lines, looking at 21 separate indices, are all aligned to the upside, and order flow and momentum aligned to the upside. Background bias is green. That's our most powerful upside alignment. We have two others that you can trade on a discretionary basis, but they won't give you a scanner signal. The C does, off of support, and on this move you get 75 cents on 10 ticks of risk. Here's Tesla. And here's, I just put these two lines in, our cash metrics. There's the consolidation signal. It's a software-generated signal to the downside. Down bias is highlighted here. This is a teal background color, also a very strong down alignment of the two higher time frames. Trade out consolidation is extremely powerful. You get 65 cents. The risk here is 15 cents. Here's another one. This is on Netflix on a 13 range. You make 99 cents on a risk of 15 cents. Now that's the conservative move. If you took the more aggressive move and allowed these small retracements to take place, the full move is all the way down to here or all the way down to here. And you'll notice this is an extreme line created by market profile. This is the end. I haven't even talked about the indicator yet, but this is the end of the volume profile, and it creates an area of support. If you took this trade all the way to support, you made it. It looks like you made well over $1.50 on this move. So you can make enormous. And remember, that's $1.50 on 15 cents of risk. So although you're going to get 5 to 6 trade winners out of every 7 trades you take, if you really run into a rough patch, you can get 3 or 4 losers and make it up with 1 winner. Now here's the market profile, and if you don't trade with it, it's going to make things very tough for you because it's based on very sound math, and the volume analysis is very key to trading with specificity and getting really good trade setups. And this is simply, this bell-shaped curve simply represents the normal distribution of any series of data. In this particular case, it's price based on time, and actually it's volume based on price. And you can see that in a perfect world, the volume distribution would be a normal curve, perfect bell-shaped curve. This is the price that's most commonly traded, and it's the point of control, and surrounding it is 1 standard deviation's worth of volume. That's really important. Now here's the market, and here's what happens. This happens on any financial instrument in every stock. When price approaches the value area high, well, first let me just mention that between the value area high and value area low is fair market value. That's where 1 standard deviation's worth of volume exists. And in an auction-style market, which is what the stock market is, traders are bidding and selling, like gavels going off. They're trading shares. One thinks the market's going to go up, the other thinks the market's going to go down, and they create a fair value for that given stock. And that's between the value area high and the value area low. And traders have decided that they don't want to trade this stock above the value area high or below the value area low. They don't like these prices. So when price approaches the value area high, it's going to get pushed down. When it approaches the value area low, it's going to get pushed up. Now the point of control is the price that's most often traded. It has the biggest volume bar. So that's a price attractor. These repel price, this to the upside, this to the downside, with price being attracted to the point of control. So these act as strong areas of support and resistance. And if you want to try to trade into them, you're going to markedly increase the risk of a trade. And remember, our goal is to avoid losers. That's our number one job as day traders and swing traders. And trading into these areas markedly enhances risk. Now, in addition, the point, and this is a lot of information to give you in a short period of time, although I'm sure a lot of you are already familiar with a lot of it. The point of control is the price at which most volume crosses. There's two critical low volume nodes which are priced at which almost no volume crosses. Traders have rejected this price. So together, for independent reasons, it's difficult to move through a low volume node in the value area high and difficult to move through a low volume node in the value area low. And what they create are zones of rejection. Now, when this low volume node is confluent with the value area high, and this low volume node confluent with the value area low, it's very tough to trade through them. And price is going to go up, bounce off resistance, come down, bounce off support, and go up. This is why you don't want to try to trade through these. Now, market profile, the indicator itself must do its analysis intra-candle, and 99% of market profile indicators do not. They make an assessment of where the value area high is, the value area low is, point of control, all the analysis at candle close. If you're trading a 5-minute or a 10-minute or a 1 hour, you cannot wait 1 hour to see where the value area high is and the value area low is. You must know at any given second where the appropriate place for these really critical areas are. And that's why you need that intra-candle assessment. It's very important. In addition, we do a look back on volume. You can't look at 1 day's worth of volume. It doesn't give the value area high, low, point of control, and low volume nodes enough stability. So we do a proprietary look back. Remember what I had said. If you just analyze data from your trading chart, you're not going to have any predictive value in determining where price is going to move out into the future. The same is true for volume. You've got to accumulate volume for more than one trading day to really give it the precision we need to call our trades off of. Now, I just created this just to show you. Price comes up, hits resistance, drops, retests resistance, and falls again. And the value area high winds up rejecting price. Price breaks support, comes up, hits resistance, and it moves to the downside. Now, we're not looking at momentum. We're not looking at order flow. We're not looking at background bias, which tells us the direction of our 2 higher time frames. We're just looking at support and resistance on our trading chart right now, just to give you an idea of how important it is not to trade into these zones of rejection. Now, here's the indicator added, and once you break support here, you can go short, but that's the only direction you can trade. And I'm telling you, I will never trade against order flow. Now, if you have any questions, I'll answer them all at the end. So I don't want you to think that I'm ignoring you. And during this period, you can only go long. We just don't have a trading entry. Here, price pulls back into resistance, and you can take the short trade because order flow is calling the short. And here you can only go long eventually when order flow turns green. So you got to trade in the appropriate direction, and you got to respect volume zone created areas of support and resistance to increase the precision of your trades, and what we're looking for is to avoid losing trades. Now let's look at a couple of these are the system generated signals, and after we do this, we're going to put it all together. I'm going to show you our trade scanner. Our scanner is without a doubt the most powerful scanner you're going to find. It's going to pull trade. If you put up 200 scanners, it's going to cherry pick the best trades out of all of the 200 stocks. This is a strategy entry, and we don't take dumb entries. This entry is not based on price action and market structure on your trading chart. It uses that, and it uses 2 higher time frames. Now the 50 is rolling and the 15 is down. We don't have any other parameters here, but it calls a short right here. You can see price falls. These are the system generated signals you're going to get off the trade scanner. Here's the strategy entry to the long side and to the short side. And you're going to see it's a multi-time frame assessment. It's an independent variable because it's looking at price action and market structure on your 2 higher time frames. It's a very difficult metric to analyze on a multi-time frame basis, but it does it. Here's our ABC entry. And the ABC entry is real powerful for this reason. If you know price action, you know that price action traders consider any 2 candles in continuity, which are the same color, to create a trend. You have 2 orange candles, the software prints an A. And then those orange candles or down candles continue. Then the software sees that you're getting a retracement or a long candle, and it creates a B. Now this is only a potential B until the candle closes. But as soon as you get that first uptick, I've elected to color my B candle magenta because I want to see it. If the B actually forms and closes, you get an audible alert. That's when you want the heads up, because you get the potential C engulfing candle. The C is going to flash, and if the C prints to the downside, the C prints and stays, you're in 1 tick below, and down you go. Now the reason it's such a powerful entry is you have all these traders calling. Now why anyone would go long here, I don't know. But I don't know why anyone would counter trend trade 99% of the times that they do anyway. But all these traders have called the bottom. They've decided that the market is going to turn here, and it's time to go long. We're going to look to exploit that mistake and run them over. What that does is it gives the down move an additional force. Not only do we have institutional traders selling more shares, but we're stopping out all the traders who went long here. So this is pushed down even harder. Here's another example. The C always exploits traders in the counter trend direction, blows them out, and the C gets pushed down with dual forces. Here is the ABC to the downside and to the upside. And here's our consolidation signal. Now consolidation is an awesome formation to trade out of. The problem with consolidation is you're never sure when consolidation is going to break. And what consolidation is a period of low volatility where the power of the bulls equals the power of the bears. You can see here you get a green candle, a doji, an orange down candle. You get a short candle, you get a long candle, and what the software does is it looks at market structure and price action on the two higher time frames and calls a break at consolidation with these triangles. Now these occur intra-candle. You're going to get a trade scanner alert. If you're trading the chart and you're just trading one trading instrument or one stock, you take the trade one tick above the close and you're going to get your nice long move. Consolidation almost always breaks in the direction of the trend if the move isn't overbought. And we use a completely separate metric that I'm not going to go into now to determine when a market is overbought or oversold. An oscillator doesn't do it. It's a different system that does. Here's another trade. I wouldn't even have seen this consolidation, but that's the channel created by the software. Now this is a risky trade. You want to go long when the 15 is crossed the 50. Here it's below the 50. So it's a tougher trade. And here's a long move, and here's a short move. Now here's our scanner. Now our scanner looks at every independent variable that we use to take a trade and shows you some of them visually. Now the quants 1, 2, and 3, those are the cash metrics. This is the background color. Here's the slope of our modified 15. This is the number of shares traded per minute, gives you an idea of volume. And the analyzer, it's the only one I've ever seen. It looks at volume. If you don't have good volume, it censors the trade. And this is AMD, or I'm blocking on it. It's Micro Devices. I've only traded it 5,000 times. Now, here's when AMD signals an alert. When it goes all red, you're going to get an analyzer flash, this purple flash. It's going to be an audible and visual alert. Now, here's how it appears when you stack it. And you can stack it for as many stocks as you want. Here's Apple, CVS, Snapchat. This is Canadian National Railway, Home Depot, BABA, Advanced Micro Devices, Target. This is Optokinetics, which is a stock I've traded over and over again. It's a small cap. This is Palo Alto Networks. Now, the only stocks you're going to be interested in are the ones flashing the alert. And you can see right here, Target is flashing an alert. And you can see the strategy entry is here. The background bias is appropriate for the trade. And it's forming. It hasn't hit. The alert is telling you the strategy entry is there. Every independent variable is aligned. You can see that you've got your cash metrics here. Now, I've cut one line out, but all 4 lines are green, and you're going to take this trade to the long side. And here's how you can stack it. And what I do is I stack a whole bunch of trade scanners and a whole bunch of charts, and I fold those charts up and don't look at them until I get an alert. Now, every trade I'm going to show you now are all alerts. They all have every independent variable you need to take a trade. This is Apple. This is just a recent trade. And these are the 2 cash metrics. Background bias is pink. And there's a couple of other independent variables I didn't go into because there's really too many to discuss in a single hour. I went over the major ones with you. It's a 13 range, 15 cents of risk, you make 78 cents. Maximum excursion. Here's Tesla, out of consolidation with the cash metrics. in your direction, background bias is aligned, you make 65 cents on 15 cents of risk. And these trades almost never fail. Now here's Facebook. I showed you this slide before. Your entry is right here on the strategy entry. Make 40 cents on 10 cents of risk. It's only an 8-range chart. Here's Akamai. Here's your order flow momentum. Here are your cash metrics right here for Akamai. Background bias is teal, which is acceptable. It's the C candle entry. There's the A, the counter trend B, continuation C. You make 30 cents on 7 cents of risk. This is a 5-range. Your entry is 1 tick below the close of the candle, and your stop is 1 tick above. That's only 7 cents you're risking to make 30 cents. It's a tremendous risk to reward ratio. This is Win Resorts. I trade options, and I like to trade Win on options. And a lot of traders think they've got to trade a big tech stock to make a lot of money. Here's 29 cents on 7 cents of risk. And Win, I like. It's very smooth. It's like Delta Airlines. I like to trade Delta because when I get a trade analyzer entry on Delta, it's a very, very high probability win. It's not going to stutter step you out of the trade because it just doesn't have that kind of volatility. When you get it, you're going to get a nice smooth move, just a question of how far it's going to go. The risk is only 7 cents on 29 cents of profit here. This is Tesla again. This is an incredibly good trade. Out of consolidation, 43 cents on 15 cents of risk. And I could just do this on and on and on. Here's the thing. If you have to look at 100 charts, and remember, you have to look at 300 charts, because in order to do the analysis that you're getting here, you've got to do a multi-time frame analysis. You can't just look at your trading chart. So you need to look at 3 time frames on every single stock you want to trade. And this trade on Tesla, I didn't go back and look and see how often it comes up, but it may only come up once every other day. When you get it, it's almost a sure win. But you can't sit around and wait for it because you need more trades. That's why you have the trade analyzer. And if you're like me, if you go over your charts at the end of the day and you look at setups and you say, my God, there was a great entry, but I missed the entry, or I wasn't looking at the entry, or I was looking someplace else. This is where the analyzer will get you into the trade. And we have tons of traders who call us and tell us that. This is what cherry picks the trades from as many stocks as you want to look at. So I just want to go back and just show you the analyzer one more time, and then I'm just going to read you. This is it. You just look for the alert. It's going to give you the entry. You don't have to trade with it, but if you want to cherry pick trades from 100 different stocks, it's great to use. It doesn't look at rising triangles and falling triangles. That's what most of those scanners do. And those are really iffy trades. Some of them work, some of them don't. They're just not powerful enough to make you profitable, which is why that 95% failure rate stands. And those types of scanners have been around forever. Bollinger Band scanners and all those scanners don't help you. And I just want to say, what we're trying to do is we're trying to check for the direction of institutional money. Which way are the institutions are the institutions buying this stock, or are they unloading the stock? And that's what all of these indicators are telling you. Where there's a multi-time frame alignment to the downside, when order flow and momentum are aligned to the downside. And order flow is a key indicator because it's telling you that there's an overabundance of sellers on the dome. And what the cash metrics are telling you is there's an overabundance of down volume. The advanced decline line is falling. There's an overabundance of down-ticking stocks versus up-ticking stocks in this basket. The ETFs are falling that are extremely relevant to the direction of Apple. So the NASDAQ in general is heading in the down direction, or this Apple subsector is heading down. And that's really important to know. And what we're trying to do is track the direction of institutional money. Because if you trade against it, you know you're never going to beat the institutional traders. And this is what the software allows you to do. Almost never be caught trading against the big money. So here, I just went through in 2 testimonials, and these are all verified. And now Jersey Tony is a top step trader. So he's verified, and he just talks about the excellent world-class accuracy of right line trading system combined with the rules of discipline that he gets with Top Step. And it's helped him become a confident and profitable trader. And he is very consistently profitable, and he's been trading with us 2.5 years. And then we have Dee Moore. He's also a Top Step trader, and the reason I wanted to mention Top Step is they give you a funded account. Everything is verifiable. And although he trades futures and not stocks, it's irrelevant. He's able to call the direction incredibly accurately, and just to go right to the bottom. Once he got funded, he had 21 straight days without a loss. And what he did was he won the $50,000 combine in 2016. He was the #1 Top Step trader in the United States, or maybe in the world, in this combine, which shows what an outstanding trader he is and really how well the system performs for him. So just to go back, we've got the multi-time frame assessment of price or trend. We have the cash metrics, which are showing you 21 market internals based on the basket that you're in, because there are 4 baskets. There's the multi-time frame assessment of order flow, the multi-time frame assessment of momentum, market profile, value area high, low, point of control and rejection zone, and the entry signal, strategy, momentum, and C candle. Now just remember, the cash metrics really will give you a great idea of what's going on inside the market you're trading and inside the basket of stocks you're trading. And it's always risky to trade against them. If they're green when you take a long trade, I'm telling you the trade's going to go, because so many things are in your favor. And our goal is to really make it easy for you to trade, or to make it easy visually for you to trade, but the analysis is extremely sophisticated. We're combining data from 3 separate time frames, and we'll also, on the cash metrics, we're looking at 21 individual metrics. Now, if you come aboard, we're going to put all 21 of those into your trader, and you're going to see each of those 21 individually. And they all come off of a kinetic data feed. So you do have to add the data feed, which is $50 a month, in order to use those lines. Now here's our webinar special offer. You get 3 months in the live trading room with me. It's not 12 weeks, it's a 10-week trading school where we teach you how to trade. And let me tell you, we purge you of all the stuff that you've learned that doesn't work. And I really teach you how to trade price action, then price action and market structure, then price action market structure with indicator confirmation. You can't trade it in the reverse direction. You can't trade indicator analysis. It's got to be that way. And you get access to our video library. We have like 400 videos showing you all different aspects of our trading, how we trade. And in addition, if you have some unusual chart templates that you need, we'll make them for you. Remember, it does a multi-time frame assessment. It's a little cumbersome to make templates. We'll teach you how to make them. But if you want to trade a 4-hour bar of some really unusual stock, we'll help you make it. You know, I mean, we have people trading 8-hour bars, 4-hour bars, you know, 5 range, 8 range, 13 range, 377 tick, 1,000 tick. You know, we'll help you with all of those. So the full indicator suite is normally $3,000, and the add-on bonuses are really a lot more money. So what we're going to do is, for the first 5 orders only, we're going to give you the trade scanner for no additional cost, and that's going to allow you to cherry pick trades from as many markets as you care to choose. If you put up too many markets, you're going to get too many flashing symbols, and sometimes if you trade all tech stocks, they may all start to flash at the same time. So you got to be careful about trading too many, but that should be your biggest problem, right? Is like getting a flash to tell you that you have a lot of potential nice trades on the chart. But we throw that in. So it's $2,900, $2,999, or 2 payments of $1,600, and the first 5 orders get the trade scanner, and the offer expires on Sunday evening. But if you're not one of the first 5, you don't get the scanner. So let me just give you our phone number, and then I'll get to questions. We're rightlinetrading.com, or info@rightlinetrading.com, and we're 1-855-765-6681. Now, the same software system can be used to trade the futures and Forex, but obviously the cash metrics don't work. They only work for stocks. Hang on one second. Let me look at the questions. Okay, hold on a second here. So I'm going to get to all of them. Okay. Bob, we are doing. Bob, you're always out there. Listen, the cash metrics. We're doing our last analysis of our last independent variable. When that's done, they're out. Okay, Bob. Okay, Tony, on one of and see today's action with this method. Yes, there is, Gene. Yes, you could trade monthly if you want. Jim, just give us a call. I will talk to you all about it. Okay, don't worry about it. Should you get free indicators as was? Free indicators? No, KG, we don't give out free indicators. I mean, the indicator system is a software package, so that's not free. I'm not sure what exactly what your question exactly is, but Jim, we'll take care of you. And Bob, we're looking at 3 or 4 days. Yes, it can go to Sierra. We just went live on Sierra, and I don't have time to project it. Sierra is an awesome platform, and everything that you see that I showed you was taken off of Ninja, but Sierra does the same thing, and you can also get the platform. Now, we have a guy at Sierra, not on TOS, I'm sorry, Fred. The thing is, if you really want to trade the signals, you can trade TOS. And listen, I love Thinkorswim. I mean, I trade all my options on Thinkorswim. But what I do is I take my signals off of Ninja because they're that powerful. I swing trade options, and I do really well with them. Oh, okay. Gene, just give us a call or give us an email regarding that, and we'll give you that option. Okay? So Fred, if you're thinking about going to Thinkorswim, you may want. That's a good question, and I do not know. I would think that you can, Fred, because I don't know. I mean, if you send us an email, we can do the research for you. The reason I like Sierra is we have an association with Infinity, and if you do 10 round trips a month, and you get the whole platform for free, you get the whole data feed for free, you get everything for free, and you pay a charge for the NinjaTrader platform no matter how many round trips you get, but the whole Sierra system is completely free of charge. So it's really a great deal, and Sierra is just projects gorgeous. It's really a beautiful software system. Yeah, listen, I agree. I mean, I like Sierra better myself. We have an association with Ninja. Right now we have an agreement to use it in our trading room. So we can't boot it out of the room. But I think Sierra is a great platform, and I really like it a lot. So I'm right there with you. So we're active on Ninja. We're active on Sierra. The next one is going to be TradeStation, and I have to tell you, I do like Thinkorswim. But the thing about it is, these trading signals you're going to get an entry which you can execute on Thinkorswim, and they're very, very reliable. Over 80 to 85% of these signals are going to win, are going to make you money. And the only thing I want to add, just hang on one second. The only thing that I want to add is that my God, I forgot. I just blanked on it. That's really about it. So give us a call if you have a question. Send us an email. The other thing that I just want to say is that it's great if you want to swing trade options. I have an options newsletter. We do exceedingly well. About 65% of my options trades are winners. The industry standard is 30%. If you can get 65% of your trading options, of your swing trading options to win, we've made an enormous amount of money this year so far, swing trading options. I take all my entries right off of my platform on my trade analyzer signals. I buy right at the money calls. If I can get 75 cents or 80 cents, I can make a nice percentage if you buy an at the money or in the money call and you do it fast. That's why I use Thinkorswim. So that's why I really like the platform. So it can be used for any of those purposes. So let us know. Either way, I hope everyone has a really, really wonderful evening. Send us an email if you have questions. Again, give me a call anytime. So take care, and really thank you so much. Thank you. Thank you very much, Or. Thank you. I appreciate. Okay, well, you know what? Hold on one second. Fred, I trade range bars, and depending upon the stock, like Google and the bigger stocks, I trade on a 13 range. I trade Netflix, Facebook on an 8 range, and then I trade the smaller stocks on a 5 range, and then the real small stocks, like the $10, I trade on a 3 range. So I'm just a range bar junkie. Eastern time, Fred. Eastern Standard Daylight. That's all. Listen, the trading methodology, I have to tell you, Gene, I don't believe there's any other way to trade, because the bottom line with what you want to do is you've got to track the flow of institutional money. The cash metrics allow you to do that. Order flow allows you to do that. multi-time frame assessment of momentum is helpful, and you can see that when they don't align, price chops, so it is an independent variable. One would think that momentum would simply align with the price of money, and money is directly related to order flow and the metrics, but it has shown to be an independent variable. But ultimately, what we're looking is to trade in the direction of the institutions. That's why Fibonacci and all those other analysis just don't work, because they don't even look at the direction of institutional money. I mean, if the institutions are coming up to a fib number, a fib line on your trading chart, they don't give a hoot about it. All they care about is they want to drive the market up, and they're going to drive it up until they're ready to stop. And you want software that tells you when they're pushing the market up, when order flow and momentum align, when the cash metrics. We have a fast cash metric line, and when they step aside, all of a sudden it goes yellow. All the volume, all the ticking, and all across these different baskets of stocks and ETFs all of a sudden don't align. If they were in the market and they were grinding away at it, they would stay in your direction. And that's when trading becomes riskier. When all of that aligns, that's when you take a very low risk, and the risk to reward is outstanding. For every penny you risk, on the average, you can make between 3, 4, or 5 cents. And if you get a 5 to 1 or 6 to 1 or even 4 to 1 risk to reward, it's a wonderful risk to reward. So, sure, thank you, Fred. So listen, everyone, have a great evening. And again, send me an email or give me a call if there's anything. And Gene, just send us an email, and I'll return. Everyone have a great, great afternoon. Bye-bye.